From the opinion pages of the Wall Street Journal, this is Potomac Watch.
President Biden rolls out the first veto of his presidency, and surprise, surprise, it's a great big favor to the climate industry and Democratic special interest groups. Also, the White House and Democrats engage in a preemptive strike against House Republicans in the upcoming budget wars. Does the GOP have a plan? And if so, where is it? Welcome to Potomac Watch. I'm Kim Strassel. I am joined today by my fabulous colleagues Kate Batchelder-Odell and Monet Ukwe-Burua. President Biden on Monday vetoed a bipartisan congressional resolution. It was his very first veto. And the history here, the Biden Labor Department in late 2022 issued a final rule designed to protect retirement funds that use ESG or environmental, social, and governance factors as part of their investment decisions. This was a big break from traditional fiduciary standards, which require retirement fund managers to maximize profits. And so this inspired a big backlash, and Congress recently used its authority under the Congressional Review Act to overturn that Labor Department rule, a vote in which Democrats in both the House and the Senate joined Republicans to kill it. Only then Biden vetoed that resolution, meaning his new Labor Department standard remains. Let's listen to Biden explain that veto.
I just signed this veto because the legislation passed by the Congress would put at risk the retirement savings of individuals across the country. They couldn't take into consideration investments that wouldn't be impacted by climate, impacted by overpaying executives, and that's why I decided to veto it. It makes sense to veto it.
So, Kate, that's not exactly how I'd put what's going on here, but the president is entitled to his spin. ESG investing has obviously been growing in controversy. Why don't just to lay the groundwork? What is it? Who's been pushing it? Why is it controversial?
Yeah, Kim, ESG stands for environmental, social, or governance. And the point here is basically to allow investment managers to let political factors influence their investment decisions. So what we're talking about, and this is a very large growing industry and may represent, even a third of private assets under management, it really allows investors to consider things like companies' climate change portfolio or the diversity makeup of their board in investment decisions. Now, the reason why I think it's becoming controversial and is really leading to a pretty broad backlash that includes states, state governors, is because people understand that this is taking the supposed sacrosanct fiduciary duty to maximize returns on their retirement accounts and allowing other factors to influence those investment decisions. Now, Kim, I just point out that if some of these factors that are so important, like social investing here, if they produce better returns, there wouldn't be an issue with making those investments. The problem here is what we're saying is basically, we are going to prioritize something over maximizing your return. And as somebody who has a 401k, that is a really big problem for Americans who are trying to maximize their savings and their retirement accounts.
Yeah, exactly. Look, there's a couple of reasons this is controversial. One, this is in part, by the way, too, it's a big payoff using government power to kind of direct more capital into a lot of the left's priorities on climate change and social justice causes. But Monet, as Kate was saying, the other reason this is controversial is, for the sake of this rule at least, is the question here is performance. And to put it really simply, a lot of people have money automatically deducted from their paychecks to save for their future. Some people might be very active about managing their 401ks, but for a lot of people here, probably the vast majority, they put it in some blended fund. If you're a public employee, maybe it's going into some big pension fund. And you just want to know that the people who are running it are doing everything they can to maximize your returns for your retirement. And you don't want to think that they're using your money to kind of fund these causes that might sound nice, but might undermine corporate returns. And Monet, correct me if I'm wrong here, but there is some real evidence out there that, in fact, ESG funds do underperform compared to their benchmarks, but also especially compared to some of those stocks that they actually shun, for instance, oil and gas companies.
Exactly. The past year has been a real reckoning for ESG funds in terms of their performance relative to the broader market. And so to back up a little bit, I think it's interesting to point out that ESG funds during the first 4 to 5 years that they became very popular actually did perform on par with the market, or in some cases even a little bit better. Part of that is because they're heavily invested in tech firms, because these tech firms are not producing emissions themselves, nor are they using suppliers who are producing emissions, what's called Scope 3 emissions that a company would include in its filings. And so they saw a pretty pretty big run-up. And a lot of these pension fund managers and other investors were able to say, we're doing well by doing good. They could point to the returns of these funds and show we're not sacrificing returns to investors because of our priorities of these environmentally sound companies. But in 2022, that really all began to reverse because as the market as a whole started to slide about 20% for the S&P 500, we also saw over-representation of some of these ESG-friendly companies, particularly in tech, sliding even more. And so out of the top 10 biggest ESG funds, 8 of them underperformed the market last year. And so it definitely should be an open question to anyone with their money in a pension fund right now. Is my money being invested in a way that is likely to produce the best possible returns? Or is the manager of my fund including other priorities along with maximizing returns? And just to finish that off, the other exception or the other reason why ESG slid relative to the market, as you pointed out, Kim, was that oil and gas actually was the best of the major sectors in 2022. It actually grew in value significantly. And so if you happen to have your retirement shuttled to an ESG fund, you are missing out on the gains in the stocks in that sector for entirely political reasons.
Yeah, and we are also seeing the benefits that have been flowing to some of those managers who did stay in oil and gas stocks and who ended up doing very well by their portfolios by comparison to everyone else. So, Kate, this question of a labor rule governing fiduciaries it's not necessarily new, even though the Biden rule only came out late last year. Retirement and pension fund managers are fiduciaries, and that means they are legally required to make investment decisions with one real purpose, which is maximizing retirees' financial interests. And that's actually built into federal law, something called the Employee Retirement Income Security Act. And the question for a while, and I think in fairness, this has been a concern for a lot of retirement plan managers, was could you even use ESG or would you potentially be subject to lawsuits? And that's why the Trump administration was actually the first, and they put forward regulations that allowed ESG factors to be used as tiebreakers when a fund manager was choosing between two equal investments. Now, I don't know if I even agree with that idea, but you could say that at least the Trump regulations were applying some safeguards against the expansion of ESG criteria. But just delving a little bit more into this labor rule that the president is protecting now, Kate, it seems to be exactly the opposite. It's very much a rule encouraging people to use these factors to expand, and maybe push managers to delve more deeply into ESG. Is that, I think, correct reading?
Yeah, it is, Kim. I mean, keep in mind that the Biden rule will protect fiduciaries from lawsuits when they're considering these factors that may be, quote, relevant to a company's performance. So that basically shields them from any liability there and allows them to invest retirement savings however they want. So it's not just, the more narrow safeguards that Trump was trying to carve out there. And I agree with you. I'm not sure. I think that allowing it to be used as a tiebreaker factor is open to interpretation. But I do think this rule that Biden is talking about is much, much broader and not only allows some narrow use of ESG, but encourages everyone to use it and makes it harder for those who think that their money has been misinvested to have any sort of recourse. So that's a much broader rule. And also, the Biden rule would basically try to empower the proxy advisory firms in these disputes as well. So that it is basically, to your earlier point, kind of an attempt to funnel more capital into their industries of choice through these very broad regulations.
Yeah, I think the lawsuit point is really key because if you could be protected from litigation like this, then you're very much leaving these pension fund managers open to all of the public pressure that we have seen out there, which has been very effective at getting companies to believe that they must adopt these initiatives and pension fund managers to take them into consideration entirely because of the risk of getting on the wrong side of some of these activist groups that then go after you if you don't. So, Monet, that brings up the point that it seems now that if you're going to make a change, especially with this Biden rule in place, that you're going to instead have to have some other officials, maybe at the state level, begin to push back on this. And that's exactly what we're seeing. I think a little bit more than a week ago, Florida Governor Ron DeSantis put out a joint statement proposed by Florida, but it was a coalition of 18 states, and they committed themselves to leading state-level efforts to protect their individuals from the ESG movement. DeSantis, for instance, and state officials changed a policy policies on Florida's more than $220 billion in pension funds to say that investment decisions should be guided only by potential returns. We're seeing this across some other states. How big of a backlash is this? Are we seeing money now coming out of these ESG funds?
Well, it has begun a broad movement among Republican governors. I believe even before DeSantis's action, the Texas comptroller decided to list several funds that would be banned for pension funds in that state to make investments because of their commitment to ESG. And I believe there are several other governors who are either considering pulling out or who have already put controls on what types of brands, what types of labels for the funds that their retirement accounts for state employees can be shoveled towards, and making sure that there aren't political considerations along with the traditional fiduciary ones. And part of that, again, is political. They don't want to be funding these investment funds that are intentionally being channeled to hurt some priorities like energy that a lot of these states depend on, and that they don't believe that there is a strong relationship between some of the environmental factors and the actual financial performance of these funds. But another reason is the fees. A lot of these funds tend to charge significantly higher fees than comparable ones from other large investment firms. And so these states that are investing over a very long term often are having to raise taxes or make other difficult decisions in order to keep their pension funds funded, pay really careful attention to those fees. And because they invest so much with these firms, they have quite a lot of leverage and quite a lot of options in terms of where they go. And so it makes sense, even on an upfront level, putting aside the potential returns down the road, to go to funds that are not going to charge fees unless those fees can be justified by an investment strategy which is actually likely to produce a better return down the road.
That's a great point, Monet, and brings to mind the fact that somehow the whole point about these high fees didn't make it into Biden's State of the Union address about the other junk fees he was concerned about.